Hello everyone, welcome to Principle of Accounting for Diploma in Business. So for today's topic, we will learn about the second topic. Okay, so for this topic too, I split into two parts. Okay, because there's a long processes based on what we have learned last week. Okay, there are long processes, so that's why I split it into two, so that will be easier for you to understand step by step. Okay, so for topic two, part one, okay, we learn about the double entry. Okay, and for these topics, topic two, basically for topic two, we have two parts. It comprises from, topic two, part one, it's from chapter two, three, and four. Please refer to the e-textbook. So basically, chapter two is from, here, this is the e-textbook, okay, from page 46. Yeah, and we will learn about the double entry, the basic concept, and then in chapter 3, we will learn about how are we going to record for the inventory. Okay, so we use different concept for topic 3, chapter 3. Yeah, and then after that, we will look into how this business transaction affect the profit and loss. Okay, so the effect of profit or loss on cap and also capital for the double entry system for the expenses and revenue. Okay, so we will touch on these three topics which is under topic 2 part 1. Okay. Okay, so after these are the learning objectives. So after you have studied this chapter, you should be able to identify the correct double entry bookkeeping into chart accounts entries, and you should be able to learn. You should be able to identify the debit and credit entries, and then we should be able to describe the causes of inventory to increase and decrease. On top of that, you also will learn on how to differentiate between purchase and sales. You should be able to calculate profit as well as enter a series of expense and revenue transaction into T accounts. Okay, this is from chapter 2, yeah. Okay, now the double entry system. As I taught you guys last week, okay, based on each business transaction, okay, each business transaction in account, we have to apply the concept of dual entry, okay, or also known as double entry system. So meaning you have to record it twice. Okay, there are two accounts will be affected, and how this transaction will be affected is based on these two items. Okay, how to classify the entry, the double entry is based on these two things. Okay, so the first one, item exchange. Yeah, so this item exchange meaning there must be movable items, there must be something, okay, from one party to another. Okay, and the second one is form of settlement. Okay, the one that I taught you guys last week was I said what mode of payment, right? Okay, so form of settlement or mode of payment is the same thing. Okay, and what it mean by form of settlement, how the transaction going take place? Is it using cash or bank, or let's say party A owe you, your customer owe you, or you owe your supplier? Okay, so you only need to look into these two things, only then you know which account to be recorded. Okay, now, for example, let's say Diana purchased a van for her business. She paid 12,000 by check. Okay. So now, if let's say you really don't know what account to be recorded, first you just look at the form of settlement. Okay. Form of settlement meaning mode of payment. So as mentioned here in the example, Diana, she paid 12,000 by check. See the bold one here, by check. So this check is the form of settlement or also known as mode of payment. Yeah. Okay. So when you want to record, okay, so you write, okay, definitely this one will, since it's check, so it will affect the bank. Okay, when and then this one you have to know as well the transaction whether it's cash inflow or cash outflow. If let's say it is cash outflow, when you paid is outflow, right? So what will happen to your bank account will become lesser, it will be reduced, right? This is similar with what we have learned last week. Okay, and one thing, one thing that you need to know when you want to record these two things, you have to understand, you have to imagine the accounting equation, account, which is assets equivalent to liabilities plus capital. Okay, so you have to imagine that equation as well. Okay, now, so that is the first one form of settlement. So you should record it. Check is as a bank lah. Okay, cash at bank or bank. Yeah, and then the first one here, there must be one item exchange. There must be movable item. So now Diana purchased a van. Van is your assets, right? Okay, so van is moved from one party, let's say the supplier A, B, C, and Diana purchased it, so she got that van. So that item exchange is the van. So van from supplier A, B, C to Diana. Okay, sorry, this is not Diana, Diane. Okay, okay, next, debit and credit. Okay, so now since you already uh so now you know there must be two accounts will be affected. Okay, it's similar with last week one. Okay, now you need to change a bit the concept. This is very very important. Okay, now when you have two accounts, yeah, you have to understand whether it's decrease or increase. You know, that concept is still apply the same, but now using that concept, yeah, whether your asset increase or asset decrease, then therefore you'll be introduced with this debit and credit concept. Okay, so debit means the place on left of the account called. Okay, meaning on the left, your right hand side. Yeah, so meaning meanwhile for credit means place on the right of the account. Okay, so debit always equal to credit, which is this usually we refer as the T form. Okay, hold on, I show you this the one in Excel. Okay, okay, let's say I have this T form. Okay, oh here, it's not that clear anyway, hold on. Okay, so can you see this? Let me make it smaller a bit. Yeah. Okay. Now, this is what we call as debit side, right? Your debit is your left hand side. Meanwhile, the credit is on your right hand side. Okay. So it's a T form. So the balance here will be equal as this. That's why the debit amount, when you total it up, it must be the same with the credit side. Okay, always be the same. Cannot be imbalanced. It must be balanced. Okay, so basically, remember in last tutorial, I did mention that this T form, for is similar with your balance sheet. Yeah, if you follow this T form, whereby the asset will be on the left hand side here. Okay, and then your liability will be at right hand side on the credit side as well as your credit. Okay, so here asset equivalent to, okay, liability plus capital. It must be balanced, always balanced. Okay, this is what it meant by this slide lah, this one. Okay, okay, now assume of double entry bookkeeping. Okay, this is all these are very important for you to understand. Do not worry as we go along with the multiple exercise, multiple business transaction. Then you guys know on which account to be recorded. Okay, now example one. Whenever there's an increase in a possession, it's always a debit. See, increase in a possession. Possession meaning it's something that you own, right? For example, assets. Assets are the resources of the businesses. Asset is the company possession. Okay, so that's why asset, whenever there's an increase, you look at the one in the bold here. Okay, whenever there's an increase in your possession or basically your assets, yeah, whenever there's increase, then you will record it in, I just put plus, meaning asset increase, you will record it on the debit side. Okay, so what about if, okay, if let's say I give you there's a decrease in your possession, what about that? Okay, if there's a decrease in your position, meaning let's say for example, you sell your van. Let's say just now Diane bought van. Now Diane sold that van because let's say the van is not fit her purpose. She needs bigger than that. She needs lorry. Okay, and then she sold that van, right? So meaning now your possession decrease, right? So when your possession decrease, yeah, you should record it the other way around here. So just minus, okay? So please make sure you understand this because you just, type it in simple form. So when your asset or your position increase, you will record it under debit. So if let's say your position decrease, then vice versa, but you record it under credit side. Okay. Now the second axiom is, yeah. So vice versa, increase debit, decrease credit. An increase in capital is always credit. See? When your capital increase, then you will record it on the credit side is a contra. So as you can see, it's actually, okay, this concept is based on the accounting equation, asset equivalent to liability plus capital, and it is based on this T form. This one, the one that I highlighted here. Okay. So now when your capital increase, okay, for example, okay, another example of capital increase, let's say Diane now, uh let's say she already run the business for 6 months, and then now she has extra fund and she want to put additional fund or additional capital into her business. Then you have to record it additional capital, okay, and you should record it as a credit side because there's increase in the capital, should record it on credit. Yeah. So what about if let's say, okay, another example to show that your capital decrease is from drawings. Okay. So remember last week I taught you guys that drawings is whatever items or things that you take out from your business in order for your own personal use. Okay. For own personal consumption, that's what we call as drawings. Okay. So now drawings, okay, you have to record it under capital. Okay, meaning it will reduce your capital. Yeah. So when there's a reduction in your capital, you have to record it on the uh, not on debit side, okay, but you will put it the remark here lah. Okay, remember like last week, hold on, yeah, I show you the item notes. Hold on. Okay, so for the drawing, this one, okay, so if there's a reduction, okay, in your capital, for example, usually it's only drawings lah. Whenever you take anything from the business or own personal use, we call it as drawing. So for the drawings, you will write it here. Okay. So if when there's a reduction in your capital, you record it as debit. This one you don't call it. You don't name the account as debit lah. It's like what we have learned last week. It's drawing. So you just write this one as a drawings account lah. Okay, which is drawings. Okay, when you take out something from the business, you will record it under debit. So this is actually will reduce your capital. Okay, so drawings you have to record it under debit side, vice versa from what you have learned here. This one, yeah. So always use the item exchange to guide you in what to debit and what to credit. Okay. So or alternatively, if let's say you really confused, you don't know, okay, whether you want to use item exchange or at least you can use the form of settlement. If it's outflow, okay, reduce, uh, Okay, reduce from, let's say like this one, you pay by check, check is bank, bank is asset. So now your asset reduce, asset are your possession. So you have to record it on the credit side. Okay, credit side. Yeah. Okay, now next. Okay, now let's look at the examples. Yeah. Recording the elements of a transaction. So now example, you entered into a transaction worth £100. If you purchase something for cash, you're recording as per exhibit 2.2. Okay. And then possession increase equivalent to debit, and form of settlement which is cash equivalent to credit. Okay. So now you enter into a transaction worth 100. Okay. So now let's say, okay, if I split it into that two items, okay, if I use these two items, okay, item exchange, yeah, for this you enter into a transaction worth 100. There must item exchange account, yeah, so meaning this is what are the things, usually it's assets lah, okay. What are the things, what are the item transferred from one to another. So if it's increased, if your position increase, then if let's say you purchase something, right, so you have to record it on a debit. Your asset position increase, so you have to record it as debit. And meanwhile the other one must be credit. It must be vice versa, it must be contra. Okay, so if let's say you pay using cash, so your form of settlement here is by cash lah. Yeah, so now cash is part of your asset. Cash is the possession of the business. But now, because you pay using cash, your cash reduce. So your possession here become lesser, right? So therefore, the other contra, okay, the other double entry that you need to record it as credit, yeah, because your possession for the your possession for this one, okay, for the possession of your cash, okay, is become lesser, right? Your cash become lesser, that's why you record it as credit here. Okay, so that's why from statement meaning this is your cash account, it become less 100. Okay. Okay, now next, if you sold something for cash, you're recording as per exhibit 2.3. Okay, so like my example just now, yeah, let's say like the van Diane own, right, van, so now van sold, so the possession now become lesser because you sold the van to other party. So when your asset decrease, you have to record it as credit when your position decrease, right? So that's why you write here item asset, let's say like van, you record it on the credit side. This is a T form, yeah. Okay. Then meanwhile, for the form of settlement, how you pay, yeah, let's say it's for cash, then this is your cash account. When you pay your van to, when you sold your van to others, and let's say the parties pay you by cash, then cash is your position, cash is your assets. Now when they bought, so you have that cash in hand has increased. Okay, so cash your possession increase, so therefore you should record it as debit. Okay, so what is a business worth? Okay, capital at any point in time is equal to the amount of owner has invested in business plus any profit less any losses. Okay, either one or this one, and then less everything taken out of the business by the owner, or also known as drawings. So the company, the business, okay, the business owner may take the cash in hand, meaning cash in the from the company, or they may withdraw the money from the business bank account, or they may take the goods. So for example, like say Diane is she has a saloon. Okay, she has a saloon, and her saloon has many shampoos, and she takes uh one shampoo and also one conditioner for herself, that is for her personal use. So that is considered as drawings. Okay, so this is the same with what I mentioned earlier here, and it's also similar with what we have learned last week. Okay, so basically, okay, capital is the total amount that the business owner has invested. Okay, so whatever amount or money that she already put in the business, and she has to add on with the any profit. Yeah, so this one plus any profit retained. If it's profit, then if it's loss, then you deduct. Okay, and then you have to if let's say you have additional capital, you add on. Okay, and then you minus with the drawings. Okay, so that is capital, how much the business worth. Okay, make it double entry. Okay, loan is not the possession of the business, so is treated as the same way of capital. Okay, so loan is not possession. Asset, yes, your possession. So for axiom 2, capital for axiom 2 applies whenever the item exchange does not belong to the business either before or after the transaction to a transaction. Okay, so axiom 2 here refers to, okay, an increase in capital is always credit. You apply this for all liabilities. Okay, for all liabilities. Okay, whenever the item exchange does not belong to the business. Okay, for example, like loan. Okay, so here now, so meaning what it meant here, loan is your possession. So loan basically your liabilities. Your liabilities can be your account payable, long-term loan, short-term loan. Okay, so mortgage loan. Yeah. So let's say a loan from other party. So all of this you will treat it the same as the capital, because loan, or let's say you owe other party like your account payable, your creditors, these are not your own possession. These are not belong to. These are not belong to the business. These are belongs to other party. Is a liability. It's a debt. Okay. Therefore, this one, if let's say you owe other party, when your liabilities increase or when your loan increase, you should record it as a credit side. Okay. So vice versa, if let's say, okay, let's say now Diane have she has this mortgage loan from bank ABC. Okay, so she has mortgage loan. So the mortgage loan is considered as long term liability, or also called as non current liability. Okay, so this liability will be if let's say Dan already have 100,000, okay, for the mortgage loan. Then she buy another shop lot, okay, let's say it's amount to 200,000. So now her mortgage loan or her liabilities has increased, so she record it as a credit. So now, maybe after a while, after a year, and then she managed to have, extra profit, and she wants to pay. Now, let's say her total loan is 300,000 and she wants to pay half of it. Okay, so when she pay, definitely there's a form of settlement, or also called a form of payment. So she may pay by cash, or she may pay by bank transfer, right? Okay, so then when she made the payment, then therefore her mortgage loan has become lesser from 300,000 to 150. So therefore, when this has decreased, yeah, so when your liability decrease, you should record it on the debit side. Okay, vice versa. So basically here, for this concept, you need to memorize at one part only. So for the one that increase, where you should record it, and then the other way around should be the other. I mean, if it's increase, asset, debit, liability increase, capital increase, you should record on credit. If let's say the other way around, okay, then you record it like asset decrease, you record it as credit. Meanwhile, for liabilities and capital, if there's a reduction, then you will record it as on the debit side. Okay. Okay, now making double entries. So we have these examples. Okay, example, you have been in the business for a few months and not kept proper records. You decided to end the business and start a new one by transferring everything to new business. Okay. So these are among the transaction that you have. Okay, you have cash of 600, cash in the US dollar, cash in the bank, in euros, computer, mobile phone, sales register, printer, printing supplies, good for sales, amount due by Fred Palmer, amount due by Winnie Wu, and also loan from bank. Okay, so you have all of this. Okay, so now so how can you record all of this? Okay, let me submit this one. So now you have all of these item, which is how many? 12. Okay. So now how to record? Okay. So you just transfer all of this. So you have cash. So now your cash is your possession. When your possession increase, you should record it as debit. Okay. So you should debit cash account. Yeah. Okay, and then what is the credit one? Okay, because this is usually when you start your business. Yeah. So another account will be the capital. So when your capital increase, you should record it as credit. Yeah, based on this concept. Yeah, credit, right? Capital increase, so you should record it as credit. Yeah. So this applies the same for the cash in US dollar, cash in the bank, cash in the bank in euros. Okay, but you have, okay, basically as we can see here, capitals are the same because this is you just transferring your money from the business, which you don't have proper, you don't keep it in proper records. No, now you want to have the proper one. Yeah. So you should transfer it under credit capital account. Meanwhile, for cashier, because it's come from various sources, you have to record it in various accounts. Okay. So this one debit cash account. So this one debit cash in the bank. So basically, cash in the bank is the bank. Sorry, this one. Cash in the bank is a bank. Okay, debit bank account. But this one debit bank in euros account, and this is US account. Yeah, you should have different account because you have four resources there. Okay, now for computer, okay. So computer is your possession, yeah. So now your possession increase, so you should write as debit computer, okay. So the rest here, as you can see, everything you move it to the capital account. Yeah, you just write capital. The total in value will be this total lah. This 600 plus 200, 1002, and everything. When you are about to start your business, all of this, okay, you will transfer it to capital account. Yeah, as you can see here, everything is capital. Is just here, okay, because this is not business transaction. It's not like what we have done. Let's say, like the example of Diane, she bought van by cash. Okay, it's not the complete business transaction. Meaning, like this case, this example, you just particularly you have all of this. Okay, you have your business, you already have your business, you're currently your business is ongoing, but you don't have proper record. So now you are about to do recording, proper recording. So that's why all of this will be transferred to the capital account. Okay, so now mobile phone, you have to debit as well because it's your position. Sales register, so your position increase. Printer, printing supplies. Okay, goods for sales. Okay, so amount due by freight. Okay, so item 5, item 10 is your position, so you should increase. So when you increase, you should record it as a debit. Okay, amount due by Fred Palmer. Okay, so amount due by Fred, meaning you lend Fred Palmer some money before this. Okay, and now amount due by Winnie Wu also same. Okay, they owe you. Okay, they owe you. So it's your possession by right. Whatever the money that you lend them is your possession. Okay, they owe you. So your possession, you should record it as debit account. Okay, now okay, so examples. Okay, this is from exhibit 2.8. Okay, whereby we look at this. Okay, the first this slide number 11, discussing from item 1 until 12. Okay, we have to refer back to the slide number 10. Slide number 10 here. Okay, for number 13, loan from bank. Okay, so how would you record this? Saying all of these are your assets, right? Your possessions. So loan from bank are not, this is not your possession. Okay, this is not belongs to company. Loan from bank means these are your liabilities, your debt. So when it comes to debt, when there's an increase in your debt, yeah, like debt is liabilities, right? Loan is your liabilities. So when you want to record it, you record it as credit. Okay, so you look at here. Okay, so you should record it as credit. Okay, so here that's why, yeah, loan from bank, credit loan from bank account. Meanwhile, debit will be your capital account. Okay, this one it will reduce your capital lah because you borrow it from others. So under the capital account, you should record it as loan from bank account. So you should record it under credit part, debit capital account because reduce this one. If let's say, because this one you just transferring all of this, you refer back to the instruction here. Okay, you just transfer whatever that you have to this new business. It's not the new one. Okay, it's not the new one. Okay. Making a entry recording an expense. Example, you pay an electricity bill for 120 by cash. Yeah. So you pay electricity by cash. So now remember item exchange. The item exchange is the electricity. Okay. So basically you use the electricity. The main supply is from let's say T and B. Okay. And now electricity has increased, right? Before this maybe like the bill is only 80 or 0, so now the coming month you have the new one, so it has increased, so you should record it as debit. Okay, now this is electricity bill. Okay, you cannot put it as asset, liability or capital. You cannot put it in that concept. Okay, so basically electricity bill is your expenses, right? So when your expenses increase, okay, so just highlight here, expenses increase, therefore you should record it on the debit side. So now I'm adding these expenses here. Wait, I put this further down. So now for the expenses, these are the things that you need to memorize. So expenses increase, you should put it on the debit side. Okay. And now you pay by cash. So cash is your position. This is position. Cash is the form of settlement. So since you pay, okay, it's no longer in your possession that 120. Therefore, it should be credit. Okay. Asset reduce to be credit. Yeah. So remember, okay, always look at the item exchange. Yeah. So and always use the assume one, okay, the position to guide you which account to debit and which account to credit. And then the other thing that you need to look into, okay, is the form of settlement. Okay, is the form of settlement. And remember, the capital is to be treated the same with liabilities. Okay, liabilities and capital are the same one. Yeah, these two. Okay, for example, imagine that the owner of the business has invested 10,000 in the cash. Okay, in the business on 1st August 2016. The result of this transaction is entered into two accounts as follows. First, a debit entry is made to the cash account. The entry includes the name of other account involved in this case. Okay. So now the owner of new business has invested 10,000 in cash in the business on 1st August. Okay. So meaning she add on additional capital. Okay. So now the item exchange is the cash. Okay, item exchange is the cash. So this cash basically is from, let's say the owner it's me, let's say it's from my own personal saving account. Now I transfer it to the business cash account. Okay, so when your cash in the business, this one cash in the business, which is your position has increased, so you will record it on the debit side. Yeah, see, you have to imagine this is a T form. Okay, so you prepare the T and then you write the cash, and then how to record this should be the way you should write the year, the month, only the date, and then this is the item. So the item that you need to write is the contra to one another. As I mentioned, you must record it double entry, right? There are two accounts name. So how to recognize? Okay, this is the cash account. Okay, the cash account, yeah, on the first August, the cash has increased. Okay, the cash has increased, meaning, but when you look at the capital, there's an additional fund being funded lah to the business cash account. Okay, so then, yeah, the debit entry. So for the Now your capital has increased, right? So you prepare capital account, capital credit. So you write the year, month, and date. So the item that you should write is cash. It must be contra. You see this one, contra to this side. Yeah, amount is the same. The what this one? The sign, money transfer sign should be there as well. Okay. So work example, a van is bought for 4,500 cash on 2nd October 2016. Okay. So now the item exchange is van. Okay, item exchange is van. Okay. And then mode of payments, form of settlement is cash. Okay. So now this one, a van is your asset, your possession, right? So when your possession increase, okay, you should record it on the debit. So you should open this one. Okay, I just write like this. Debit, and your account will be, your cash will be credit. Your position increase and then you pay by cash. Your cash is a cash outflow. You paid, right? Because you bought here. You pay by cash. So what happened to your cash? Your cash will become lesser. Now your position become lesser. When your position become lesser, right? You will record it on the credit side. So you open the cash account, right? This is a continuation from the previous one, yeah. It must be a continuation. This is from here. So you already have your cash account for 10,000 and now you record it on the credit side, van 4,500. Okay. Meanwhile, for van, you open a new account. This is debit. It will increase. So you write down the year, month, and also the date. The item that you should write here is the contra one, which is cash. Meanwhile, for cash, the item that you need to write here is van. Okay. So the value is the same. Yeah. So this one debit, this one credit. Okay, next, fixtures. For example, shelves are bought on time from shop fitters for 1,250 on 3rd August. Okay, now fixtures. Okay, for fixtures and fitting, as I mentioned just now, it can be the decoration of your office. Okay, drawings, painting. Yeah, drawings. I mean, is a paintings. Okay, so you bought this. Okay, remember like last week when I highlighted that the form of settlement, okay, or mode of payment, it can be cash, bank, or pay later, right? Pay later also known as on time. Okay, so if it's on time, meaning this company, okay, they bought first, they bought the shelves, they use it, yeah, from shop fitters, but they will pay shop fitters later. Okay, so meaning is a liability, meaning the business owe to shop fitters. Okay, so shop fitters is your account payable. Okay, so you should write your shop fitters account. Okay, so now before that, your fixtures, your assets, right? So when your asset increase, you will record it and debit. Yeah, because your position increase. Yeah, your position increase, you should record it as debit. Okay. So this one bought on time. Okay, you owe them, so you pay later. So now your liability, right? Your liability decrease. When your liability decrease, you should record it on the credit side. Okay. Sorry, liability increase. Liability increase. Right, before this maybe you don't owe shop fitters, so now your account payable you could just increase, so you write as shop fitters. So fixtures, debit, the title, account title, okay, the year, month, and date, and then the item here you should contra with the other account, which is shop fitters. And same goes with the shop fitters, but I prefer you guys, okay, to not to confuse you, because you will see a lot of company's name. Yeah, you will see a lot of company's name. So here you should write as AP lah, account payable. Then you put it dash. I prefer to prepare in such way. I prefer to prepare in such way, so that we'll be able to differentiate between account payable and also account receivable. Okay, so the item date must be the same, and then the figure also must be the same. Okay. So if let's say you have multiple transaction, okay, and various parties, so maybe you have to open this T account many lah. Yeah. Okay, number four. Examples. Okay, you paid the amount owing to shop fitters in cash on 17 August. So now you owe them, right, just now. So we proceed from the previous one from here. So now you pay them, yeah. So when you pay them, hold on, yeah. So here you pay. So when you paid, right? See, by cash. Form of settlement is cash. So when you paid, your cash is your assets, asset is your position decrease because you pay, right? When your position decrease, you should record it as credit. Yeah, so here cash. Okay, this is from the previous one, So August 17, you write. Okay, this one you don't need to write because you already write here. So 17, so you write shop fitters. Okay, because you owe him, right? So you pay 1250. So in the shop fitters account on the 17th August, you should contra it lah. So this is shop fitters. This is from the previous one. Yeah, you pay by cash. So right here cash, this is the same amount. Okay, right. Okay, so that is for the first part from chapter 2. Okay, so now this one is a bit complex, whereby in chapter 3 you will look into the inventory. Okay, so like last week, okay, for whatever, whenever you bought goods or you sell goods, you will see the effect on the accounting equation. Yeah, you see the effect on the accounting equation. So now we want to look on how this transaction will affect the inventory as a whole. Okay. So now usually, okay, the first, please make sure you understand the concept is like last week, whenever there's a effect, business action effect the inventory. This is just, we want to look at how this business action affect the accounting equation as an overall. Okay. But basically for the inventory, normally, okay, the goods and services, okay, under the inventory, they are sold at a different cost price. Okay, and the difference, because usually we bought goods at different price. Even let's say we have multiple, let's say, okay, I example like manufacturer of the laptop. Okay, I used to buy these Intel chips from I used to buy these chips, okay, laptop chips from Intel. Okay, and the prices, okay, might be, let's say I bought this Intel chip 1, 2, 3, the same model, but I buy it at different time and at different uh, unit, okay, and it will give me different cost price. Okay, let's say the first batch I bought from Intel for chip A, let's say 1,000 unit, and they're selling to me like $20 per unit. Okay, and maybe like after a month, okay, I want to buy the same chips, but I buy it at much lower units, maybe like 500 units. Then they will sell to me. Okay, the cost price for me will be slightly different. Okay, so now whenever when we purchase this at different price, and when we want to sell, we will sell it at different price. This is the price different. This is what we call as profit. Okay, but as long as, okay, you must ensure as the businesses, when they want to sell their goods, their products, okay, or services, usually it will be much more higher lah compared to the cost price. Only then you can declare the profit. Okay, and it's very rare lah for the businesses, they want to sell it at the lower cost price. If let's say product and services being sold at lower price, then the business will have loss. But it doesn't mean that the business cannot, but it does happen. Yeah, maybe at a certain condition, for example, like those fast moving consumer items, okay, for consumer goods. If let's say it's about due, okay, there's a due date, right? Okay, the expiry date, yeah. If they say a certain product are about to have their expiry date, then they might sell it at slightly cheaper. Okay, maybe they have certain profit, but if they say uh it's about to reach the expiry very soon, then as long as they can clear the stock, there's a possibility whereby they will sell at much lower than their cost price. Okay, at least they have something rather than nothing. Okay, so now an increase in inventory can be due to one of these causes. Okay, so how your inventory increase? Why? What are the causes? Yeah, so when your inventory increase, this is due to when the business owner purchase additional goods. Okay, purchase more product. Let's say I'm a manufacturer, laptop manufacturer, and I buy all the raw materials. Okay, and I make that new laptop, so I will have more in my inventory. Okay, that is in the case of manufacturer lah. So I need more raw material. If let's say I'm just a reseller of laptop, okay, I buy from, let's say, in Dell. Okay, I buy 100 units of Dell laptop. Okay, model ABC. Okay, so therefore in my inventory it will increase. Yeah. The second reason is the return into the business of goods previously sold. This is another condition. First, definitely the purchase, now the return. Okay, we have done this last week actually. Do not confuse yourself, yeah. So now, we are using the same example of a computer manufacturer. Okay, we're using the same example. Now, let's say I sell my laptop to this reseller in Petaling Jaya. Okay, so this reseller, okay, they bought 100 units of my laptop. Okay, they bought, okay, and then they check. No, I transfer that laptop to them already. I already transport everything to them, and then they check. Once they check, and then let's say they found out one of it default, cannot use one. Okay, so they need to return back to me. So when they return that broken laptop to me, then my inventory will increase, even though that laptop is already broken. Okay. So now, to distinguish the two aspects of the increase in the inventory, okay, that's why two accounts are open. Okay, so now increase in inventory because of these two reasons. Okay, we refer back to this one. Okay, and because of these are different things, right? Different reasons. So that's why we have to record in two accounts. Okay, so that's why you have to record it in two accounts. So whenever you buy, okay, you purchase goods. Okay, whenever you purchase good, therefore you record it as, you are no longer name it as inventory. Yeah. Okay, so you will open an account, what we call as purchases account. Okay. Meanwhile, for those items that being transferred back to the business, you will record it as return inwards. Okay. So these two transactions will affect the inventory. So that is the increase. Okay. This is based on increase in the inventory. Okay, next, a decrease in the inventory. What are the causes of decrease in your inventory? Okay, so the decrease in the inventory is because of two causes as well, which are, the first one is the sale of goods. Let's say in my warehouse, I have 1,000 laptop, 1,000 units of laptop. Now I sell to reseller 1, reseller 2, reseller 3. Okay, I sell to them, therefore in my inventory has decreased. So when I sell to them, that's what we call F sales, the normal sales lah. Okay, normal sales, yeah. And then the second one, goods, the decrease, yeah, the decrease in the inventory because goods previously bought by the business now being returned to the supplier. What it meant here, right? So let's say, because I'm using the example of manufacturer of laptop, right? So now assume, let's say, okay, I'm a laptop reseller. Okay, I buy laptop from Dell. Okay, let's say I buy laptop from Dell, and then I check, and then I found that one of it cannot use. Okay, so I have to return back to them. I have to return back to supplier lah. So basically now let's say I have 100 unit, one of it broken, so I return one, so I left with 99. So now there's a decrease in my inventory. And this apply the same concept as increase in the inventory, because we have two reasons that decrease the inventory, right? And because of that, we will open two accounts in order to differentiate these two causes. Okay, if let's say your inventory is decreased because of your customer, okay, buy it from you, you sell it to your customers, so you open a sales account. Meanwhile, if let's say your inventory decrease because of the default in the product, meaning you return it to your supplier, therefore we open an account what we call as return outwards account. Okay, so meaning you return back to the supplier. Okay, so this is the two account that you should open when there's a decrease in your inventory. Now let's look at this example. Okay, on 1st August 2016, goods costing 165 are bought on credit from D. Henry. Okay, so 1st August, goods costing 165 are bought on credit from D. Henry. So movable item here. Okay, so now for inventory, you imagine, okay, when you buy goods, your inventory will increase. So basically here, when your goods increase, this is because of purchase, right? You bought, so it's a purchase, so you have to open purchase account. So now purchase account is your, see, I'm adding more here. So when you purchase, you should record it on your debit side. Okay, debit side here. Okay, but when you make sales, you will record it on the credit side. Okay, and this one is on credit. You see, mode of payment, form of settlement is on credit from D. Henry. So meaning you take the goods first. Okay, but you don't pay D. Henry yet. So D. Henry is your creditor or your account payable. Yeah, your account payable. So you should record account payable is your liabilities, right? So account payable is your liabilities. Therefore, yeah, whenever your liabilities increase, so you should record it on the credit side. So year, month, date is the same. Okay. So other purchases, because the form of settlement you owe the Henry, so you write his name lah, and then you open his account, and here the item that you should write is purchases contra with this. Yeah. Okay, next. Purchase of inventory for cash. Just now when you owe the party. Okay. Meaning you buy on credit, you pay later. So now what about if it's based on cash? So example, on 2nd August 2016, goods costing 310 are bought. Cash being paid. Yeah. So this is the form of settlement. Being paid for them immediately at the time of purchase. So now, okay, goods costing, so you purchase, right? So when you purchase, your inventory increase, therefore you should record it as purchases account. Purchases account, when you increase, you will record it on the debit side here. So it applies this concept. Okay, and then, okay, you pay, the form of settlement is cash, right? Cash, you pay by cash. So what happened to your cash account? Your cash will become lesser. Cash is your position. Cash is your asset. When your asset reduce, then you will record it on the credit side here. Okay, so here, right, your asset reduce, you should record it on credit side. So you write the year, month, and date, the item here, the name, you should contra it with the purchases. Yeah, so the amount is the same. Okay, next here, sale on inventory, sale of inventory on credit. Okay, is the similar one with the previous, which is this one on the 1st August. Sorry, just not purchase. This one sales. Okay, on 3rd August, so 16 goods were sold on credit for 3752 daily. Okay, so now goods were sold. So when your goods were sold, let's say your laptop sold, so now your inventory become lesser, right? And this is what we call as, instead of last time we record it as inventory, we should record it as sales. Okay, so sales always, whenever there's an increase in your sales, so that's why you record it on the credit. This is contra lah, right? Purchase sales, right? When you purchase, you will have more. Then when you sell, you record on credit. Okay. So here sales credit. Okay, since the party is daily, you owe him. He is your customer, your debtors, your account receivable. Okay, you sold to him, meaning you transfer the laptop to him, but he has yet pay you 375. He owe you, he will pay you later. So daily is your customer. Okay, so here you write daily, month, year, month, date. Okay, here this is the party who owe you. Okay, your customer, so 375. Then you open the daily account, which is your customer. Okay, here the item you should write as sales contra lah. Yeah. Sales account receivable, purchase account payable. Yeah, I just write it here. Yeah, so for purchase, yeah, purchase, when you bought it from your supplier creditor, which is your account payable. Meanwhile, for sales, this is your debtors. Okay, which is your account receivables. Okay. Okay, now what about sales of inventory for cash? Okay, on 4th August 2016, goods are sold for 55. Cash being received immediately at the time of sales. Okay, so now goods are sold. So what will happen to your inventory? Your inventory will become lesser, right? So when you remember when your inventory become lesser, and this is due to sales lah. Okay, so sales you have to record it on credit side. Yeah, so sales credit. Okay, now you make payment by cash, so you should write year, month, date. So the item here by cash. Yeah, so when you pay by cash, cash is your form of settlement. Okay, this cash is because you pay. Sorry, this is what you sell. So you receive the cash from your customer. So your cash is your position. Position increase. So should record it on the debit side. Okay. So here debit side. So the item should write here is contra with the cashier should write as sales. Okay, now it's we come to written inwards and written outward. Okay, written inwards, so meaning into the business. If it's written outward, so out of the business. Okay, so written inwards, basically you will receive the goods from your customer or your debtors or your account receivable. So basically they still owe you and then they return back to you. Okay, now, let's look at this example, 5th August 2016. Goods which had been previously sold to Afflower for 29 are now returned to the business. Okay? So you sold to Afflo. Afflo is your account receivable. Okay. So written in words because it's into the business and it will affect your inventory. Your inventory will increase. Yeah. So written in words, you will record it as a debit side. Okay. So the other one is written outward, should record it as credit. Okay. Should record it as this. Yeah. So written inward, debit, year, month, date. Okay. Here the party name. Who is the person written to you? You write down the name and you open the account. Okay. Maybe before this you have reservation with him. Yeah. So here the item name that you should write is written in words here. Written in word. Okay. Or another word that you can use for written in words is sales written. Sales written. Another account name for this one. Sales. Okay. Okay, now return outwards. On 6 August, your 16 goods previously bought, okay, you bought that for 96 are returned by the business to Keho. So basically, Keho is your supplier lah. Okay, he's your supplier. Now you return back to them. So now return outwards, you should record it as a credit side. Okay, as I mentioned just now. Okay, return outward also called as purchase return account. Okay, this is the other name for the sales outward. Okay, you should record it as credit. So here you need to write the party's name. Okay, let's say you're like this one, you and your supplier. So basically Keho is your account payable. Okay, so this must be contra lah. Okay, the item right is written outwards. This is the Keho account. Okay, now special meaning of sales and purchases. So both sales and purchases have a special meaning in accounting. Okay, so purchases means the purchase of those goods which the business buys with the sole intention of selling. Okay, and meanwhile, sales means the sale of those goods in which the business normally deals and which were bought in the prime intention of resale. Okay, so remember, like last week, I've shared with you guys during the tutorial session, you have to able to differentiate usually how I explained about how you can have this account receivable and account payable in accounting. Okay, basically when you have that, when other people, let's say you and your customer owe you, and that one is related directly to your main product. Okay, so that is sales with you and your customer. Okay, so basically sales, it's only the product, it's regard with your main product, but you also have sales of other things. Let's say you sell of your assets. Okay, so you don't use sales account. Okay, so when you record the sales and purchase, it's only related to the business, it's only related to your main product or services. Okay, it's not like selling your asset, buy your asset. No, it's not. You should not write as sales and purchases. Okay, only the one related to your main product. Okay, so that's it for the topic, chapter 3, how to record where for your inventory, which basically you have your account, sales account, purchase account, return inwards, and also return outwards. Okay, the last part here for the chapter 4, you will look into the effect of profit or loss on the capital, and also the double entry system for the expenses and revenue. Okay, so now the nature of profit or loss. Okay, hold on. Yeah, I think I've made some mistake here in regards with this one. If there's an amendment, I will update you guys. Yeah. Okay, now, uh, okay. So by nature, profit means the amount by which revenue is greater than the expenses for a set of transaction. So usually businesses, when we want to make business, we want to have profit. So profit meaning that's the amount that you will earn whenever you sell your items, your product or your services more than the purchase price. Let's say I buy a laptop for 200 and I will sell it at 500. So my profit will be 300. Okay. Okay, now revenue means the sales value of goods and services that will be supplied to your customer. Okay, meanwhile expenses is the cost of everything, okay, that you need to use for your business. Okay, so here expense mean the cost value of all the asset that has been used up to obtain these revenues. So meaning, in order for you to have your revenue, you should have the expenses first. Okay, because without these expenses, you cannot achieve your revenue. You cannot achieve whatever your goals. Okay, so now calculating profit, if we supply goods and services valued for sale at 100,000 to customers, and the expenses incurred by us in order to supply those goods and services amounted to 70,000 pounds, the result will be a profit of 30,000 pound. Okay, so let's say you bought everything at 70,000 and you are selling it at 100,000, therefore the 30,000 will become your profit. So the effect of profit and loss on capital. Okay, so again, this is related with what we have learned before. This one, yeah, how this would affect, yeah. So based on accounting equation, we have, yeah, is from asset equivalent to liability plus capital. So this one we rearrange lah, ha. We rearrange. Therefore, the capital is equivalent to asset minus liability. Okay. So when profit has been earned, this will increase the capital. So that's why here, when you have the profit, you should add on. Yeah, should add on. But if let's say you have loss, then you should deduct. Okay. So this is the all capital, meaning the beginning capital. Okay. Uh, the beginning capital you should add on with the profit. So you have new capital. But if let's say you have to deduct it if you lost, you still have the new capital. Yeah. Because loss will decrease your profit. Will decrease your total capital. Okay. So this is basic concept lah. Okay, whenever you sell more than the purchase price, the cost price, you will have profit. If you sell less, then you have loss. Okay. Okay, now recording expenses. In order to calculate profit, okay, expenses must be entered into appropriate accounts. Okay. A separate account is opened for each type of expenses. Okay, so you should able to appreciate, okay, whether this is expenses or this is profit. Yeah. So bank interest account. See examples. These are among the example. Bank interest. Bank interest. Okay. Usually bank charges the interest. Okay. We also bank interest is our expenses. Okay. Overdraft interest also expenses. Audit fee, insurance account. If let's say you subscribe, let's say a magazine, okay, or newspaper for your staff, or e-newspaper for your staff, the subscription is considered as expenses. For example, nowadays in most offices we have this water filter like Kuku, Kowe. That one is considered as expenses. The normal expenses that you have come across, for example, like marketing, advertisement, telephone, utility bills, motor expenses, okay, rental account, postage account, stationery account, and so wages and salary accounts. Okay, so debit or credit. Okay, so asset and expenses involve expenditure by the business, and expenses will record it as debit, as I mentioned just now, right? So expenses you will record it as debit. So whenever your expenses increase, you will record it as debit side. Yeah. Revenue is the opposite of expenses. Okay, this is the contra. Yeah. So whenever your revenue increase, basically your revenue, okay, you will record it as credit. Okay, revenue you will earn it. Okay, or another word, yeah, is actually from your total sales lah. Okay, it's the same lah here. Yeah. So it will be credit. Yeah. So this is you should memorize. It's the same one with what I prepared here. You have expenses, losses, assets. Oh yeah, losses. Remember we have drawings, right? We also should have losses here. But basically, it will reduce your capital. Okay. Okay. So revenue, profits. Revenue. I'll just write like this. Whenever you have increased liabilities and capital. Do not forget these two as well. Written outwards. Okay, this one written in words. Yeah. Mm. So these are is when the expenses increase, you should record it on debit. If it's decrease, then you should record it as credit. Yeah. This one, when you want to memorize, make sure you memorize when they are increased, when they are increased. Yeah. If it's decreased, then it should be the other way around. Okay, now double entries for expenses and revenue. Rent for 200 is paid in cash. Okay, so rent. Okay, bear in mind, if let's say they don't mention rent, because rental, basically we have income and expenses. Okay, if like they don't mention anything, you should assume that rent is your expenses. Okay, there are also cases whereby rent can be rental income. That why you should record it as your revenue lah. Okay, so when your revenue increase, then you should record it as credit. So now rent 200 is paid. Rent is your expenses, so expenses increase, you should record it as debit side here, right? Expenses increase, should record it as debit side. Form of statement is by cash, right? Cash is your position, right? When your position decrease, cash is your assets. When your asset decrease, you should record it as credit lah. Usually you need to memorize one side and then the other side will be the other way around. Okay, so that's why here credit. Yeah. Okay, next, motor expenses of 355 are paid by check. So form of statement is by check. Now it's paid. Check, it's bank, right? Bank account. So what will happen to your bank account? Bank account is your position will become lesser, right? So when your asset become lesser, you will record it as credit. That's why here credit bank account. Okay. Meanwhile, you will record the motor expenses as debit. Okay, next one. Example, £60 cash is received from commission earned by the business. So cash is received. So what will happen to your cash? Cash is your position. Cash is your asset. Your asset increase, right? So when your asset increase, you record as debit. So that's why here debit cash 60. Okay. Meanwhile, the credit is the commission earned. Commission is your revenue profit. When your revenue or profit increase, you will record it as credit. Okay, here just write commission received. Sometimes you will have commission pay. Commission pay is considered as expenses. So now let's look at this. For example, 1st June, paid by postage stamps by cash 50. So this one paid. Postage stamp is your expenses, right? So this one, okay, when you paid, okay, so your postage stamp will be your expenses, right? And then your credit will be your cash. Cash because it become lesser. Your cash because you paid, right? There's a cash outflow. Your cash is your asset. Asset is your position. When your position decrease, you should write it as credit. Okay. So this one we prepare it in the table T form. Okay. So now you see cash credit 50. So I write lah. Okay, open cash account. Okay, I open cash account. Wait, let me zoom it a bit. Okay, open cash account. So June 1st. Okay, I need to refer back here. June 1st. Okay. So here for postage stamp. So you write the postage stamp. This one, right? Just write postage stamp. So this is cash account 50. So and then you open a postage account. Postage account, right? I just refer back to here. Postage account debit cash. So postage account debit. So postage account is your expenses. Expenses increase, so you should record as debit. It's contra with cash, so you write cash here. Should be contra. Okay. And then the second one, say June 2nd, paid for electricity by check. This one by check. So this one will affect on your bank. So your bank account will reduce. So bank will become credit. But you write electricity. So here, hold on, let me type here for a while. So electricity is your expenses account. When it increase, it should be debit. I write. Okay. And then your credit will be your bank. Okay. So you open bank, right? June 2nd, electricity, 229. See, 229. And then you open this one settle. And then you open the electricity account. Okay, debit, you write 229, debit, okay, electricity, see, this is on debit side, June 2nd, but the item you should write bank lah. Okay, you refer back to here. You should write bank lah, this one done, right? So you record this one, the same amount, 229, from here, and then here, see, electricity, bank, bank. Okay, and then rent, receive rent in cash. So this one rental income. Because this one receive rent. So rental income is your profit. So now rental income is your profit. So you should, whenever there's an increase, you should record it as a credit. Okay. So here, but I write debit first because now your cash will increase. Okay. So you open account, rent receive here. This is the account. Oh, so rent receive cash 139, right? Is a profit, right? Here credit. See with this. So but item because you pay by cash. So here in your cash account you will record it increase lah. Rent receive increase when your asset increase, your position increase, you record it as debit side. Okay. Oh, one more here. Paid insurance. Insurance by check. So your insurance is your expenses. So here insurance, okay, and then your credit will be your bank. Credit will be bank because you pay, right? Your asset will become lesser. So your bank here insurance bank become lesser. So credit lah. Okay, the insurance is an expenses. Expenses increase should record it on the debit side. Okay, now for the drawings. So for the drawing, we open one drawing accounts lah. Okay, one account. So basically, drawings that the owner takes, money that the owner takes from the business for private use is called drawing, and it's not only limited to money. It can be the product, okay, the goods, yeah. And then drawing reduces capitals. They are never an expense of the business, yeah, because no, because you use it for your personal use. So an increase in drawing is a debit entry in the drawing account. Okay. So drawings, as I mentioned, you should record it as a asset here. Sorry, you should record it. You should record it as debit, and you treat it same with the asset. If asset increase, and then the credit entry is against cash or bank, okay, or the product. Okay, if money was taken from the business or purchases, if and if it's purchases, this one I would like to highlight. If let's say cash or bank, that is the credit entry. Okay, but if let's say they take from the stock, then you write as purchases lah. Because you purchase is in fact your inventory, right? So you should record it that way. No longer you use the inventory. The inventory, the effect on inventory is only for the topic one when you want to look how this will affect your accounting equation. Accounting equation, we only have asset equivalent to liability plus capital. So this is an example. On 25th August, the owner takes 50 cash out of the business for his own use. Okay, so as I mentioned, drawing will be always be on debit. Okay, the one that this one, sorry, should memorize this. Okay, debit entry. So the item that you should write is the this one, cash. Okay, so it takes cash, so you should write cashier, month, date, okay, the amount, and then you open the cash account. Okay, August 25th. So the item it should be drawing, it should be contra, same amount of 50. And then examples, okay, on 28th August, the owner takes 400 of goods out of the business for his own use. Okay, now he's not taking the cash or withdraw the money from the bank, but instead he takes the good out of business. For example, like during the tutorial session last week, I mentioned that if let's say, okay, I take three laptops, one for myself for personal use, and the other two is for my children's. Okay, for our own personal usage. Yeah, it's not for the business, so that one we should record it as drawings lah. Okay, so how could when we take the laptop, because laptop is the main product for us to resell, so we should record it as drawings, and then the goods here you should record it as purchases, because when you purchase it will affect your inventory. Okay, so the contra account here, drawings always be on debit side. Okay, and if you take your main product, so you will reflect on your purchases here. Your purchases will become lesser, so that's why you record it as a credit side. Okay, so purchases credit here, the name is drawings 400. So we know lah. So let's say the laptop here, so we have drawings for personal use, we know. Okay, they take one of the laptop for the personal use. Okay, so the things that you need to memorize is this one. Okay, but alternatively you can refer to this one as well. But this is not like very detailed. But in the next chapter, yes, you have more items on this list. Okay, but I will share you guys in tutorial class during the tutorial session on how to easily memorize each one of these item. Okay, so please do read this, since this is slide together with my explanation. I hope everything is clear. So I really hope that you guys can have a look on the e-textbook and try to attempt a few of the tutorial question. Yeah, so please make sure this Wednesday and also Thursday we'll be having the tutorial for this chapter. Okay, for this one. Okay, that's all. Thank you for today. Thank you for listening. Should you have any inquiry, please write down everything and do ask me during the tutorial sessions. Okay, or if you since we'll be having tutorial session on Wednesday, if you have any doubt, you just do drop me an email or just can chat with me via Times. Okay, thank you.